Okay, welcome everybody. Thank you for coming out this evening for part 3 of a 4-part series. The anatomy of an insurance claim. We're going to be sharing tools, tips, strategies to survive the disaster, after the disaster. What does that mean? That means how do I navigate my insurance claim without having a disaster? Losing a property is one disaster, and then the disaster of not knowing how to navigate and negotiate with a huge multi-million and billion-dollar industry becomes problematic. So we come out and share information, our knowledge base, to help you understand how to navigate, talk about issues. We will be having a microphone around, so for those of you that have a question, just raise your hand and give us 20 seconds for Rich to scoot across the floor and get a mic on you, because we'd like everybody to hear the questions. They're really good questions, and we'll obviously try to get to every single one of them. My name is Reno. I'm joined by my esteemed colleague here, Ken Crown, Richard Villanueva, and out front is Kyle Hensick. I've been a public adjuster for 24 years, serving and as a public advocate for folks like yourself. I was a fire victim myself as well. That's how I got into this business. Ken's been in the business 34 years?
Yes.
So
yes.
Over 50 years just between us, and we're licensed in multiple states, as the laws vary from state to state how the insurance companies are to do business and handle their contracts and pay people. And that's over 50 years doesn't include Richard and Kyle's experience either. So plenty of experience out here, so we can definitely answer those questions. We're the Greenspan Company. We've been in business since 1947. Equally as important, we are a local Bay Area company. We're not from out of state, like a lot of these stormtroopers are that come in from different parts of the country to handle your claim. How many people here have an out-of-state adjuster they're dealing with? Yeah, it's a lot. We see it quite often, and it becomes problematic, and we'll get into how that affects you down the line. Many people ask us, and I get asked, and you get asked, what is a public adjuster? What is it that you do? So we thought this video would answer it best.
When disaster strikes, the personal and financial stress can be devastating. What should you do? Your insurance company will send out an adjuster to assess the damages and determine how much you get paid. Feels like you don't have too much say in that process. Insurance companies control their claim payments to be profitable, and they employ their own adjusters to limit their financial exposure. But who's fighting for you? What if you had your very own adjuster, known as a public adjuster, an experienced insurance professional and his team working exclusively in your corner, saving you time, negotiating the optimum amount on your behalf, and lowering your stress through the complicated and confusing process of disaster recovery? That is exactly what we provide for you. The insurance company's adjuster works for the insurance company to negotiate and adjust the claim on their behalf. A public adjuster represents you to the insurance company to ensure that the claim is handled fairly, quickly, and with optimum financial resolution. Not all insurance company adjusters are required to be licensed or tested by your state. A public adjuster is licensed, bonded, and tested by your state to represent your interests only. The insurance company's adjuster is paid by the insurance company they work for. A public adjuster earns a success fee based on a percentage of the settlement or other method of compensation. Having your own public adjuster assures you of a fair fight. And most importantly, we help you get back to your life, family, or business sooner. So the next time disaster strikes, don't stress, don't wait. Call the Greenspan Company Adjusters International. We work for you.
We're going to spend about 10-15 minutes on a few topics for tonight surrounding the structure. And as bullet points, what is the definition of a primary dwelling versus a separate structure? We'll be talking about foundations, debris removal, which is a very hot topic at these firestorms, rebuild or buy elsewhere, or do I walk away?
There is one thing worth noting, and that is, if you're choosing not to rebuild and you're going to go and buy a replacement home, what you can do, and we'll use the example we had earlier with the $800,000 house and the $400,000 extension, you could go out and buy a home that needed significant improvements. Let's say that it was a little dilapidated. You can then go and use some of those monies to bring that house back up to where it needs to be. So yeah, as long as you've agreed ahead of time that you have a budget of, you know, whatever it is, $1 million, and the monies that are into the extension, you can buy a home and start fixing it in order to use some of those monies that you otherwise wouldn't get if you didn't perform.
You had workshops, you had detached garages, and so you want to move what you can under what would normally be deemed a separate structure over to the dwelling. And we can talk more about that, but that's basically the definition. It would include walkways, retaining walls,
Pools.
fences that are not attached to the house, pools. Barns.
Yeah. Foundations. How many people here want to or think they can salvage their foundation, their slab? Anybody? Last week we had quite a few people, and it was interesting. How many people here know what spalling is? Spalling, S-P-A-L-I-N-G.
Do I need to list every item? Yes. Now, there's a couple of insurance companies out there that are doing categorical outdoor furniture,
Slab, and it wicks out the
clothing, just lump sum.
slab.
And that's okay. That'll save you a lot of time and grief.
You realize it cannot.
But most of them want every item listed.
For those of you that
And
salvage a piece
if I was insured with a company that wanted categorical, I would still list every item, because if there's a second avenue for recovery, whether it's through
salvage it is
potentially an insured casualty loss, tax write-off, or subrogation, I want to know what my true losses are. So it's really critical to really capture it.
debris removal. Want to talk about how debris removal works?
No. An easy example would be a laptop.
We have
And you had an HP laptop before, and you've always wanted an Apple laptop. The value of your recovery will be based on the HP laptop that you lost. But if it was depreciated $150, when you go out and buy an Apple laptop, you're going to spend a lot more than that, but that $150 is now recoverable.
bad information out there, and a lot of people that think that the information they're receiving is correct. So we want to dispel some rumors and talk about it.
How many people, show of hands, know what the definition of replacement cost value is?
You're going to do a remodel to your kitchen. You're going to rip out the old cabinets.
So the definition in California is replacement cost
And then you're going to
less depreciation brings it down to actual cash value. It's the fair market value of the item.
to the base limit of your
No different than buying a brand new car, you drive it off the lot, it starts.
And the only way it becomes additional coverage up and above that policy limit is if it's proven that the damages are greater than that base limit.
They want to try to turn the print very efficiently, both from a time perspective and from a dollar perspective. That's why they use straight line depreciation,
Reach the limit of their
which
policy.
really makes no sense if you think about it. I mean, to look at a chart and to suggest that a couch has no value after 10 or 12 years
Part of
is
reconstruction.
ridiculous.
So if
Now, at my house,
Kenny, can you give that example?
it has no value after 12
You have a
years.
limit of 40.
I have 3 kids, I have a dog, a cat, and the entire neighborhood of kids seem to congregate at my house. My couch is worth almost nothing 6 years into it.
Let's
And yours
assume
might still
for a
have the
moment
plastic on it that you remove twice a year with another company.
building replacement,
So 6 years into it, is it fair to say we have the same value
the damages.
in our couch? Absolutely not.
Like
You want to take control of that.
But now you have a debris removal bill that may be $40,000.
What they'll do is they'll come up with a number. So for example, if you've got $100 and they're taking $20 off, you're gonna get $80. That's your actual cash value payment. That $20 is held back by the insurance company as a holdback. It's a depreciation holdback that is recovered if you have replacement costs, and most of you do, more than likely.
Cal recycle
So they pay that $20 back once you've spent
Go
$100.
ahead and clear the lots. Whatever is not covered under your insurance policy gets paid for. And these debris removal costs, we had.
You're
them in
claiming
town
the antiques,
anywhere from
and they can't be depreciated. By the way, an antique in California, the
clearing
insurance,
site,
the insurance code is 100 years or more.
and it's
So if that item is $200,000, for example, it's $200,000. Any supporting documents that you can have, finding it on eBay or wherever, Sotheby's or an auction house, to support it, that's fine.
Jim, we're gonna have Rich run around here.
Can you hear me?
Yes, oh yeah.
All right, so what my question is like, I'm thinking about my coverage on my policy, and it specifically said, like, debris removal, like 16,000 and something. And so the insurance company wrote me a check separate from the dwelling coverage specifically for the debris removal.
Okay.
And so what my question is like with the Cal Recycle thing, is that the number they're gonna be looking for, saying, okay, your policy coverage was 16,000 for debris removal, so we're gonna request you give us 16,000?
Exactly.
Is that what?
Exactly. And then whatever the difference is, which probably is going to be more, will be picked up by the state.
So it's up and above. Yes, we got a question over here. Be right there.
Sorry. Can everybody hear me?
Oh,
Yep.
yeah.
Okay, just didn't want to talk too loud. So like, for instance, my debris removal is only 5% of the dwelling.
Right.
Okay, and I know it's
Gonna be way
above,
more.
way above that. So if they're refusing to unlock the additional debris removal funds, how do you deal with that?
Why don't
Well,
you reverse engineer it like we
Yeah,
did, so-
I will. So let's assume for a moment, in that $400,000 dwelling limit example that I just gave, let's assume that the building repairs are only $300,000 to replace the building. And debris removal costs are $50,000. That's all covered within the $400,000. So in that scenario, the $50,000 would go to Cal Recycle, and the $300,000 would go to you for the cost to replicate your building. So it may very well be that they don't want to unlock it because they're thinking maybe you're not going to hit, in this example, the $400,000 limit. And that's, and by the way the recycle program works, my understanding is the Cal Recycle doesn't get paid until you get paid first for your loss. Specifically for an example like that, where it may end up being you have more than adequate coverage or you don't. More likely you may not. And that's one of the reasons why Cal Recycle, they may send in a bill, but your insurance company shouldn't pay them until they've at least measured your loss and you know you're going to exceed your limits. And then they would only get paid that extra 5%, and you would get your full limit.
It's really critical that that base limit, when you look at your policy, and by the way, how many people here have ordered a certified copy of their policy? Certified copy of the policy. Yeah, it's not the way they mail it. You have to order it. Comes in from underwriting. It's stamped. And what it is it shows the latest forms and endorsements of that policy year. Because how many people here have gotten that one pager in the middle of your policy year and it says California endorsement change, and you look at it, it's like, oh, well, just throw it in the drawer in the trash. Well, that's a language change in your policy, and you need to know what it says because it may affect how the valuations and how things are written in your policy. So a certified copy will be the latest forms and endorsements that are written into the policy, and it's stamped from underwriting, and they send it. It takes a couple of weeks for it to come in, but stay on top of the adjuster, stay on top of your agent. You got to get yourself a copy, folks. That's the rule book. And without the rule book, you are not in the game. Because when that adjuster cites a portion of your policy, and he's reading it off to you, or he sends a copy of the little excerpt of that endorsement, you're not going to have anything to reference it or challenge it for that matter. So it's really important that you definitely get it.
And by the way, with the policies, this is important, and we'll talk about it in an example. a lot of these adjusters, they're not California adjusters. California is much different. It is believe it or not, it's a pro-consumer state when it comes to insurance. And there are special endorsements for California that give you more coverage. We had a State Farm adjuster from Texas who told the client that they don't collect for code until you incur it. They don't collect for the extended replacement costs, which is typically 20% under State Farm, until you incur it. Well, that's not true in California. There's a special endorsement that allows them to get paid up front. So it's real important, and we'll give some examples. Question, yes?
I have a question. We received our declaration page, but then he emailed us the 50-plus page. That's still go ahead and order
Could
the
be a
certified.
specimen copy.
Yeah. Who's your carrier? Yeah, they're doing that. It's not certified, but I will tell you the State Farm policies haven't changed in a couple years. The declaration page should give you all the coverages. Now, the only difference is when they email you the specimen policy, it doesn't have specifically that endorsement, which is FE 3422 is the endorsement. And that's the endorsement that changes the language in the body of the policy that will allow you to collect the 20% extended replacement costs and the code upgrades without having to replace. However, you got to prove that the cost to rebuild is going to be more than 120% of your base limit. And the code upgrades under State Farm, typically it's 10% of the base limit. You have to prove to the carrier, these are the codes that are being required through the county or through the city, and this is what it's going to cost. They're not just going to pay it.
We have a question here.
Yeah, did you say that on those exclusions, like the overcost for reconstruction and the dwelling extension, those are all supposed to be paid up front based upon California law? Is that correct? Did I hear that correct?
Only on State Farm.
That's okay. That's why I'm
Yeah.
asking the question.
Yeah,
Yes.
and you're looking for that code, that endorsement number is FE
3422.
3422. It'll be on your deck page. You'll see it. And then when you cite the policy, it'll spell it out. But we have, just on the heels of Santa Rosa, we handled a tremendous amount of clients there, and the ones with State Farm were getting paid, right?
Yeah, they got paid. It's not going to happen overnight. You got to still document that you're owed that amount. They don't just
In
write.
what manner? How
Oh,
would you go about
you know,
documenting that?
We're going
Yeah.
to talk about that.
We're going to talk about that. We're going to show you and explain to you. We'll pass out some sample claims. We'll tell you how the insurance company does it, what you should do. Obviously, I assume everyone's met with their adjusters.
Okay.
Have any adjusters been switched out already?
Reassigned?
Wow, already.
Yep.
Holy cow.
Okay, we'll talk about that. So the
Okay.
next topic is rebuild or buy elsewhere, or do you walk away? And there's a slide that talks about that. So if we were to look at your claim as a pie, the biggest chunk of the pie obviously is your dwelling. And this represents just the basic limit. That's that base limit you bought. Then there's this part, which is the extended replacement limit, the extended replacement cost endorsement, which most, if not all, policies will have. How many people here understand what extended replacement cost endorsement is?
Yeah, but can you explain a little bit more for the extended?
Yeah, we're going to get into that. Yeah, we're going to get into the details and the weeds. And,
I'll do that.
and yeah, absolutely. And we'll answer the question. So that's why we're asking, kind of taking a poll of who understands it. Personal property, right here, it's another big chunk of your claim. So the dwelling and personal property are usually the two biggest, of course. There's holdbacks, meaning depreciation holdbacks, which we'll talk about. Separate structures, like we mentioned earlier, pools, sheds, cabanas, walkways, driveways, walls, etc. Code upgrade claim, we're going to talk about that. ALE is additional living expense. That's your temporary housing part. Debris removal is this sliver right here. And then your trees and landscaping. So that's what a claim, if you were to look at it on a pie, that's what it would look like. So we're going to cover, the way we will talk about this program is you've got 4 claims going on at the same time, and each claim has subclaims. So the way it breaks down in your policy is A is dwelling, B is other structures, C, personal property, and D is loss of use. A, B, C, and D. We're going to go right through the slide system as A, B, C, and D. So there's three scenarios that we typically see in these wildfires. And one is, I'm not going to rebuild. I'm going to talk about what happens here. The other one is, I'm going to purchase a replacement property somewhere else. Doesn't have to be here. You could be in Arizona or Washington State, wherever. Rebuild on site. I'm going to rebuild right on the site. So let's talk about the no rebuild option. If you choose this, what happens, Kenny? Can you explain this here, please?
Sure. So if you don't rebuild, other than State Farm, by the way, that has that special endorsement, in this scenario, they would only owe you up to $400,000. That's assuming they agree that the cost to replicate your home is more than $400,000. And there are some issues we'll talk about later, because technically, under California law, when it's a total loss, they don't owe you your limit. They owe you the fair market value of your building without the land. So I think CSAA and some of the other carriers are doing appraisals of what your property was worth right before the fire.
How many people here understand the appraisal value road? How many people here have gotten a number on their appraisal? Okay, not so many. Okay.
So it's the market value for your home without the land, because technically they don't insure the land. And under California law, when it's a total loss, it's market value. When it's a partial loss, it's replacement less depreciation. But in this scenario, we'll assume that the market value is $400,000. The debris removal is going to be that extra $20,000, which will certainly get exhausted. And then you also have what's called landscaping coverage. And that gives you up to another $20,000 for damaged trees, shrubs, bushes, grass. And by the way, there's usually a limitation on trees. Some policies have $750, some are $500, some are $1,000. Some policies exclude forestry, meaning they'll pay for the trees that you plant, but if you're in 10 acres and it's all forested, some of the policies don't cover that. And by the way, if you haven't figured it out, $750 or $500 is not a lot of money. You'll spend $700 just removing a tree, let alone putting up a 20-foot tree or 10-foot tree. And by the way, this slide, the one thing it doesn't have in it is other structures. Sometimes the carriers will pay for other structures even if they do a fair market valuation, but typically a fair market valuation will include the other structures.
Does this make sense? So if you don't rebuild, these are the benefits under your policy, assuming there's a base limit of $400,000. Any questions so far? Okay. Next scenario is we're going to purchase a replacement property somewhere else. So a door opens up here. Things are different. This is the different piece of it, a benefit that will open up. Base limit again, $400,000. Debris removal stays the same. It's 5% of this as long as we exceed this number. You get $20,000. Landscaping, same things, remains the same. Extended replacement cost endorsement. Some of them are 50, some of them are 20, some of them are 150%. How many people here have extended replacement cost or have talked about it with their adjuster? Okay. Well, the way it works is, excluding the State Farm thing, policy, to get this door to open up to more coverage, this extension, this additional coverage, it has to be proven that the damages are greater than $400,000. Okay, that's critical. So when you look at the base number, you have to exceed it. If you can prove that the damages are greater, then the door unlocks to this additional coverage. And you have up to another $200,000 in this example. Additional increase due to declared catastrophe. We've seen some policies out there that have an endorsement that basically say, if in a declared disaster zone or catastrophe, that the policy kicks up in the extended replacement cost in A, B, C, and D. all 4 buckets get kicked up, not just the building.
Based on whatever the increase for the dwelling limit is. So, and by the way, here's what's important. You don't get the full 50% if, in this scenario, the agreed repair costs are only $500,000. You'll get an extra $100,000. And if you have a policy, and there's very few out there, where it allows coverage B, C, and D to increase, it's typically based on whatever the increase is for coverage A. So if coverage A increases 25%, then the limits for other structures increases 25%, personal property, et cetera. And what's also important to know is some of these debris and landscaping coverages, the way they read in the policy, some of them say that we will pay 5% of the stated limit. In that example, $20,000. However, I found recently some nationwide policies where we're going back to the carrier and we're reading it and we're seeing it says 5% of the applicable dwelling limit. So the applicable dwelling limit, assuming that you're going to need that extra $200,000 to rebuild, would be $600,000. 5% of $600,000 is $30,000. You now have $10,000 more of landscaping coverage. And if you're on 3-4 acres, you're going to have that or more.
So it's important, yeah, so it's important that you understand how the policy responds to the loss. Every home is different, every fit and finish is different, the policies are all different, not all the same. So that's why we urge you to get a certified copy of your policy.
Yeah. Should I talk about safe? Yeah, sure.
Question over here? Mike's coming down.
And then I'll tell them my Safeco story real quick.
Sure.
Yeah.
Keep it brief.
Can we talk about, I don't know, I have some specific numbers, or maybe you're gonna show some other illustrations, but I'm just trying to figure out how this works. Is that okay?
If you want, if anything
Or-
specific for privacy reasons, I think you should talk to us after this.
Yeah.
Yeah, that way
Yeah.
we want to keep your privacy.
So
We
just
out of respect.
Yeah, just real quickly, we were talking about the increase due to declared catastrophe. So in the Santa Rosa losses, Safeco had a policy that said, due to the demand surge or under extended replacement, we'll pay up to 50%. And a gentleman came to me and he still didn't have enough coverage. And then I remembered in Lake County, I had a Safeco policy, and there was a special California endorsement. And when he met with us, we only get involved where we can make a difference. And I said, I don't think I can help you out, but you know what? I want to go back to my Lake County loss because I think there's a special endorsement with Safeco. And the endorsement read that in the event of a declared catastrophe, that 50% doubles. He hired us pretty quickly because now we had this coverage. We sent over this special endorsement, which he never got, because he didn't get a certified copy of the policy. And the Florida adjuster, I've never heard of this. I said, well, you better check with your home office. In the meantime, there's all these groups of people talking with one another. All the Safeco policyholders are getting together. When I got done telling him about this, he went to Safeco. The next thing we find out is all the Safeco adjusters are telling him, oh, if you had this policy, you actually have 100%. So it's so important to look at that because that can be a big difference in being able to rebuild or not rebuild.
Yeah, and it's a lot of money to leave on the table. And look, no fault to the adjuster, he just doesn't know. He's from out of state. He's not working with these special California endorsements. Any questions on this part here? This,
I have one question for you.
yes, sure. Microphone's coming over. It's important for everybody to hear it because these are good questions.
Just a question. You said these adjusters from out of state.
Yes.
Okay. Aren't they all required to abide by California law regardless if they're here, from there, or somewhere else?
They're
They
supposed
say,
to.
well, I
but-
didn't know about that. Well, that's too bad for you.
Yeah, they're supposed to, but look, Santa Rosa was absurd, and who would even think 1,000 homes would burn down? And
Yeah.
but that's the reality now, and they don't have the people and the manpower for it.
So it's up to us to make sure that we're
No.
aware of it.
Yeah,
It's
it's
up
your
to the
duty.
insurance company to do it.
Right, but it's your job and duty, and it says it in your policy, it's on a couple of front pages there. In the event of a loss, it's your job to prepare a claim, present it, and negotiate it. And in the absence of doing that, you allow the insurance company to do it, you're just going to be in the grinder. And, you know, it doesn't make them bad people, it's just the business of insurance. So you're the consumer, you bought this contract. And this contract has specific language, conditions, definitions, the do's and don'ts. What are their obligations? What are your obligations? So it's really, really important to be proactive because you're making a claim to them. They're not making a claim to you. And they have no duty to perform. They'll do it. But there's no law in any state that I'm licensed in, okay, that says they have to be accurate. It's just a matter of an opinion of
Yep.
what they want to pay you.
There's a conditions section on the policies, and obviously you're not going to go through in the detail, but it's pretty clear. It says that you, the insured, are obligated to present your claim. You must prove your loss and damage. You must separate the damaged property from the undamaged property. Provide us documentation to support it. You don't know how to do that. The insurance company's aware of it, so they go out and they measure it. And maybe there's a benefit to them. They're handling, you know, these adjusters have a couple hundred claims. They're not going to spend or be able to spend the right amount of time to properly document the loss. They're going to try, but it's pretty difficult. So you got to be very proactive.
Question over here? I'm sure.
Should put on my running shoes.
I know. I was trying to think of how to ask the questions without specifics. So if your replacement cost value was higher than your base limit and your extended replacement cost, okay, and so you wanted to go buy another home, part of what's confusing is of like kind. So if you wanted to buy a larger home, you know, could you do that and then still collect on, you know, as long as you're, the way I understand it is you're trying to prove in your replacement that those costs exceed essentially
Yeah.
what your coverage.
I think I know your question.
You understand the question?
Yeah,
Okay.
so let me, and we kind of talked about it, but I'll go over it again one more time. First off, you have to get the carrier to agree that your loss is more than the 150%. So if they agree it's $600,000, then you have to go out and you buy a property. Now, as long as the property you're buying without the land is $600,000 or more, you're okay. However, there are some carriers, and we had this situation with Hartford, where I think they had a 2,200 square foot home. There was an agreed amount, and they went ahead and bought a 2,700 square foot home. Hartford, in their infinite wisdom, even though they spent the money, the insureds, the agreed amount, Hartford says, you know, you're bettering yourself. You're getting a bigger home. So what we're going to do is we're going to take the purchase price, we're going to divide it by the 2,700 square feet, and then we're going to multiply it by the original 2,200 square feet that you had. And this was a big battle. I mean, we went all the way up to the top because in California, there are some case laws that talk about it doesn't matter in replacing. You can replace the home any which way you want as long as you expend the money. So, you know, just be aware of that. That could possibly happen. Maybe what you want to do is, here's my replacement home that I'm planning to purchase. The land value is this. Insurance company, do you agree that you'll fund the remaining 50% that I'm owed because I'm replacing it? They say yes, go ahead.
Yeah, and that's a good point. You have to put them on the hook for that money, period. Do not go out and assume anything because anything can happen. It's too much money to make,
Rich,
right there, to mess around with. So once they're on the hook in writing that they've agreed that the replacement cost value or your policy limit, in this case it'd be 4 plus the 2, 600,000 for example, that they're on the hook for it, now you know you've got that budget. Then you go out and purchase. Don't go out and buy. That's a good song. Don't go out and buy without understanding what the ramifications are. Question over here.
Okay, so they say that you can purchase a home and you don't have to purchase it in California. You can purchase a home anywhere.
Correct.
Right.
So, and they try to get you to do a like kind. So say, okay, we're done, we're not gonna rebuild in Reading, we don't wanna stay in Reading. So we're gonna go buy our house that we've been wanting to buy in Maui.
Okay.
Okay, so say we're gonna get $400,000. Well, a house or a condo in Maui, you're gonna get a 1-bedroom for $700,000. Will they still give you the whole amount because you're not buying a house that's like kind?
In my opinion, yes, as long as the condo that you're buying without the land is equal or greater than the agreed cost of repair.
Yes.
I didn't have a question. I was going to make a comment. The way that my insurance is doing it, because we were actually starting to rebuild before the fire, a new house on another property, and we lost our house, the whole thing. And
Sorry to hear about that.
yeah, me too. What our insurance is doing, because we're not rebuilding on the same site, is having a contractor come up with the cost to replace the house in kind at today's prices and they're gonna take that cost and give us the difference between that and what they gave us as the fair market value for the house that burned.
That's correct.
That's nice, but is it accurate? We find errors, we find omissions, we find linear feet shortages, we find windows are missing or too many wall sconces. You gotta look, when you get that. Oh, you are, okay. Oh, you're, okay, I thought it was the insurance company, because,
Okay.
yeah.
Well, so the question is, if I get a dollar amount, besides buying or rebuilding on site, can I rebuild somewhere else? Absolutely. The only caveat you have to be aware of is they only owe to put it back on the site you had. If you rebuild somewhere else, and the code upgrades end up being higher because the code requires at this site to have deeper footings, then that portion they would probably not want to pay. With code upgrades, if you can, yeah, it's different in every county, but with code upgrades, they owe you for the code that would be required at the site. So if you've got lots of loose soil at a new site you want to rebuild and it requires deeper footings, they don't owe for that. They owe for what you had before plus code upgrades. And some policies don't allow you to transfer the code upgrades, but especially if you're going to buy a property. But most of them out there, at least 60, 70%, will pay you for code upgrades if you rebuild at the site or rebuild at another site, but only for the measured code upgrades at the site that damaged.
Question?
So you're talking about, if you go and buy something bigger, but what if you use the opportunity to downsize? Like, do they, you said don't go out and buy. My mom went out and bought, but she went much smaller than what she had before. So she still should get her full.
The example of the condo in Maui, which is probably a lot smaller than the home you had, that would be a similar example. A home here to rebuild versus a home in San Francisco. So no, you can downsize, and quite frankly, of course, the reverse argument where an insured bought a bigger home. Well, that's a perfect example. I bought a smaller home. Why can't I still collect for it? So absolutely, you can collect. And in my opinion, I think, even though the insurance company made an argument, I think that as long as you expend the money, that's all that's necessary.
So if we were to purchase a smaller home in the same county, and therefore, I'm a teacher, so, and therefore that smaller home costs less, we don't get the difference in cash because we didn't expend the money.
That's correct. So, but I'm going to throw another wrench in this because it's important. Let's assume you buy a home, and the home you buy without the land is $500,000, but they measured it at $600,000. So you've left $100,000 on the table. You don't have to just leave it on the table. Maybe the home you're buying doesn't have the nice kitchen that you had. Maybe it doesn't have the bathrooms that are more modern. You can take that $100,000 and decide to remodel portions of it. You're spending the money. So that's important, and my guess is a lot of people didn't think about that. And we've had clients where they go ahead and they do that. Or even in some instances, it was a smaller house that they purchased. They have money left over and they do an addition.
Okay, got another question here.
Yeah.
Hi, can everybody hear me?
Yes.
Okay. So, for example, I'm really not concerned about confidentiality, so I'll just lay this out. My insurance has already basically told me that if I choose to buy a replacement home, then they're not going to give me the extra 25% for my extended replacement cost.
That sounds ridiculous. You challenged that, and did you ask why?
I did, actually. I talked to the guy's supervisor, and she told me that she needed to speak with him about that. And then...
Who's your insurance with?
Farmers.
Okay.
Case in point. Which
And then they also told me that I had to be at 90% built before they would give me the extra 25% on my extended replacement cost. And with this many homes needing to be rebuilt and a lack of contractors, if I'm not there yet, then I lose that extra 25%. So it's
Okay, so let's take it one step at a time.
Is that even written in the
I know,
policy,
no.
90%?
Well, no. What's written, some policies like farmers, you have that extra 25%. And what happens is, technically, if you read the endorsement, it says they don't owe it until you actually repair or replace. So you're not going to get it, like we talked about, until you actually start the construction. Now, whether they owe it at 90% completion or 75%, but they certainly owe it when your contractor is at a point. Let's use this example, and let's assume the costs are $600,000. You're at a point, your contractor is doing the work, draw payments are being made, maybe through the escrow, through the mortgage company. And by the way, don't pay your mortgages off if you're going to rebuild.
We're going to get into that.
Yeah, and we'll talk about it, but don't do that. So in this scenario, if once your contractor's near $400,000 and you give farmers the contract and they see it's $600,000 and there's a draw payment due, ask for 50% of the remaining 50%. So you don't have a cash flow situation. But they are correct. If the endorsement reads they don't owe it until you've actually replaced it or repaired it, then it's a matter of making sure that they don't have you stretched out, that you give them proper notice. I mean, truthfully, I think it's stupid. If they see you've got a contract and you're 70% complete, they should just pay the remaining balance.
Yeah, they get commitment, be proactive, put everything in writing. I just had a thought. When you communicate with these adjusters, memorialize that phone call in an email. After you hang up with that, he or she, basically, you put an email out and say, my understanding of today's conversation was bullet point, bullet point, bullet point, please confirm. Now you have an electronic paper trail, because when that claim, and it will, get reassigned to someone and then another person and up to 7 sometimes, you don't have any track record of what that conversation was, you're going to be in trouble. You're going to be stalling and be in trouble.
I think it's also important to note that the first adjuster that you deal with, if you are transferred to a second adjuster, does not have to agree with the first adjuster's position. So documentation.
Yeah, memorialize it. That's a great point, Richard. Thank you. How many people here have called the lost draft department at their mortgage company? How many people here don't know what a lost draft department is? Hands? Probably 50%. Want to talk about it?
Sure.
Actually, strike that. I'm going to get to that. I want to finish this slide. Sorry, we kind of got off track. Just remind me. So rebuilding on site. Same thing. Base limit. Debris removal stays the same. The benefits here are the same. Benefits here are the same. And here's what we were talking about earlier. The code is now available. The code. Okay, so these are your 3 scenarios. Any questions on these 3 scenarios? Most people fit into one of these 3. Okay, back to the mortgage company. Every mortgage company has a little department in the back called the Loss Draft Department, LOSS as in Sam. And you need to call them, let them know that there's going to be a settlement check coming in, and what is their protocol to release funds back to you so you can make repairs if you're going to rebuild the house on site. And if you can imagine, the check comes in and you don't call them, and now you have your name on it, you sign off on it, it's got the mortgage company's name on it, and then you send it in, and they're going to say, oh, paying off the loan. Great, you just got all this money. And when you have plans to rebuild. So every mortgage company has a different protocol. Typically, the lost draft department will send out a package. You fill out the package, send it in. Now you've got your file set up. The check comes in, they look at the file, meets protocol, and then they usually release it in thirds. So if you have a $300,000 settlement, you get $100,000 to start. Once you exhaust that, you call them up, say, hey, I need another draw of money to complete my project. They'll send out either representatives to make sure you're spending the money on the project and not going to Vegas or buying a car or something like that, because they have an insurable interest in the property, up to the amount of the note. Okay.
So let's talk about that for a minute.
So let's say, for example, let's say you have a $400,000 settlement and your mortgage is only $100,000 remaining. Should they, question I would have is, should they be entitled to hold the other $300,000? No. So you can ask the carrier, it's like an act of Congress, we were talking about this earlier with Dean here, to cut two checks. One that conforms to the mortgagee clause in your policy with your name and their name for $100,000. That's in compliance to the policy. And the other $300,000 should come to you, liquid money. It should be no encumbrance on it. We have a question.
We have that exact same scenario that you're talking about, and the insurance company just sent us a check that's quite a bit more than what we owe on our mortgage company.
Okay.
And I called the insurance company and said, okay, why can't you just send a check to the mortgage company for the amount of our loan and we get the rest? And they said, no, we don't do that. You need to send the whole thing to the mortgage company. And I'm like,
Okay.
so then what do we do?
Yeah, it's like an act of Congress. Well, they're in compliance, I mean, realistically. So when you ask them to cut two checks, they're stepping outside the four corners of the policy. Now, they're doing it for you, I understand. Okay? So, you know, if they won't do it, and they don't have to, then you would have that check go to the mortgage company, and then you're going to negotiate with your mortgage company to release the difference.
Yeah.
Okay, and sometimes it takes 30, 60 days, but there's no way around it unless they're in. Yeah.
But what about if the check includes not only the dwelling, but the personal property? They've combined them. So the mortgage...
That's a major problem. They should.
Yeah.
Those four buckets are to be paid separately. Don't get duped into this one check for this, this, and this. It's very confusing. Each A, B, C, and D bucket are separate. They're going to get paid separately, and you want to keep those separate.
Yeah, you never combine personal property payments with dwelling
Yeah,
payments.
that's a problem.
Unless you don't have a mortgage. Yeah, we have a bunch of questions over here.
Yeah, I came in late, so if you could, at some point, say whatever you did about State Farm. It sounded like there have some exceptions. That's one question. The other one is about architect, and I'm having trouble getting State Farm to agree to pay for the architectural redrawing of the plans, which I believe is required because of the county.
Sure.
County requires it.
Yep. The answer to your first question is look on your deck sheet and look for FE
3422.
3422. That's the endorsement number. F as in Frankie, as in Edward, 3422.
Well, I think the question has to do with the measurement and getting State Farm to agree to pay it. That endorsement, by the way, allows you to collect the agreed upon code upgrades, and if they agree that the cost to rebuild is 120% of your above your or 20% above your stated limit, then they'll pay that up front, not subject to you having to actually rebuild or purchase. With regards to State Farm, this is not news to us. We ran into this in Lake County. There are some contractors that, they don't hire an architect. They get a draftsman, but they have to get an engineer to stamp the plans. It's kind of crazy doing that out here, and depending on the type of home you had, it may warrant an architect. They're just not used to paying that. The architect's costs, though, should not include redesign unless there are no plans at all. If you've got an old set of plans, They owe to make those plans current, which means basically taking them, putting them on CAD, and then to make the plans code compliant as well. So as long as architects can charge 10%, they can charge 12%, they can charge 8%. Figure out what that percentage is for design if you already have a set of plans. State Farm would not owe for that percentage because the house is already designed. But if you don't have any plans whatsoever, then in a way you're having to redesign your home.
Does that make sense?
Sorry.
You know, you can. We'll be up here afterwards,
Yeah.
guys. So if you
Yeah.
have something that's you're still confused about, we'll be here all night if we need to be to talk to you one-on-one. I'm sorry?
No, I'm not saying that. What I'm suggesting is that in Santa Rosa, people used architects, although they weren't at the 12 or 15% range, because they were doing multiple houses. Everyone's different. I don't know what kind of home you had. You can go the draftsman route, but if you had a custom home to begin with, and it's high end, I think you want to go with an architect.
Question here.
So if the insurance company cuts you the check and your payoff is less than what you're getting the check for, can you just take that to the title company that originally settled your title on your home, have them take care of the mortgage and cut you back the check?
That would be the
And
lost
not-
draft department. Would you
No,
not?
she's saying a title company.
Yeah.
I don't know about that. I think you have to, you
I
know.
mean, it's written to us and the mortgage company.
Right.
But it's a substantial difference, so they're gonna sit on that for, what, 2 or 3 months or
Well,
whatever?
no, I don't think they sit on it that long, but what you have to
Okay.
do is you call the lost draft department. I've got a check, I want to pay the loan off, I need to get paid the difference. You put it in right, you find out, you know, what the process is, they'll give you a current payout, you instruct them in writing to pay it out. You find out in advance what's the time frame. You confirm that in the letter that you send, and you send it in.
It has nothing to do with the title company, from my understanding.
Yeah.
So you
It's
don't
the
have-
mortgage company. and the
Okay,
lost
mortgage
draft
But could the title company handle all that for you?
No, it's
I
the
don't
lost-
think so. I think
Okay.
This is a
it's-
settlement, yeah.
This is and you're
It's
the mo-
different
the
than
t-
buying a home, it's a settlement with
Correct.
the insurance?
That's correct.
Yeah.
Okay.
So we live in the county, and we've gone down to multiple places looking for any plans that they have on our house.
Mhm.
And we can find absolutely nothing.
Okay.
And so what pool or what pot does the draftsman or the designer, or where does the architect come from?
The dwelling.
Right here, coverage A.
Coverage A, the
Anything
dwelling.
to do with your dwelling is the dwelling.
By the way, it's important to know, some of these carriers, especially, you know, like State Farm and Farmers, they're so used to not paying architecture fees or permit fees or soils engineering because, oh, we only pay it when you incur it. In California, that's not correct. They owe the cost to replace less depreciation if it's a partial loss. So if you have a policy with State Farm and they say, oh, well, we don't owe it until you incur it, no, you're owed for it up front, especially if you have that special endorsement, because it is part of the cost. And then if they say, well, but you're buying a property, no, I'm still owed for the architectural fees that I would incur to replace that property, because the property I'm buying, the home I'm buying, had architecture and engineering fees. It's built into the selling price. So just be aware of that.
Everything's
So-
negotiable, by the way. Go ahead.
So to answer her question, I'm in real estate and I deal with the title company all the time, and I have the same scenario where I got a large check and it's a lot more than what I owe on my home. And so I called my title officer that I work with all the time and begged them, can I just give you the check? Because the trust thing. And he explained the whole process and told me I need to get a hold, and I did that and found out how to do it. But you cannot go through your title company.
Correct.
You have to go through the mortgage company.
Yeah, because they hold the note. Okay. Okay. So these are the three scenarios. Any questions on this? Yeah, I got one more. Yes, sir. It's okay.
That's okay.
And they're talking about architecture fees,
That's
Correct.
correct.
Okay, and in our case, we were told right up front, we'll pay them and that's where it comes from.
And what company are you with?
About State Farm.
These adjusters are all over the map. Your adjuster, you could have the State Farm, same carrier, your adjuster and his adjuster and their adjuster. They're all running at different operations.
We're on the same street, we both got burned out.
Yeah, so it sounds like you're getting paid for it and you're not. Is that correct? Isn't that
No,
interesting?
I think here's what I think's happening.
Hey,
It's-
yeah, but
I think this gentleman here is they're saying, well, why do we need to pay 10% for an architect when some of these homes are being built without an architect? That's the issue. And everyone's different. In Santa Rosa, there were architects involved.
I want to talk about the not returning your call. That leads me to something. In California, the insurance code mandates that once you communicate with or ask a question or you're trying to communicate, they have 15 days to get back to you. Now, some adjusters are cool and they'll get back to you within a few days. Some will be 14 days. Some will be 18 days, 19 days, 20 days, and they're out of compliance. So just, you got to stay on top of these people. So it's 15 days, guys. That's what the code requires for communication. Okay, back and forth. Any other questions on this dwelling? Yep,
Yes.
we got one here, right here. These are great questions, by the way, and thank you
Yeah,
for sharing.
keep them coming.
Hi again.
We can hear you.
I guess my, I don't know if my question is for this part, but it's, I guess, coverage D, which would be
We're gonna get
loss
there.
of use.
We're gonna
So
get
we're
to
gonna
that.
get there.
Yep.
Okay.
We're gonna get to
There'll be a
that.
slide for that specifically.
Yeah, we'll move it
So
along.
on dwelling, that's those are the three scenarios. These are the issues that you'll be looking at and dealing with. Moving on. Coverage B. Okay, other structures. The 40,000, we got this because it's typically 10% of coverage A. And coverage A, if you remember, was 400,000 in our example. What is other structures? Garages, workshops, detached fencing, retaining walls, landscape, walkways, driveways, patios, sprinklers, exterior lighting. How many people here believe that your solar panels are other structures, or is it dwelling? Anybody? Both? You must have been here last week.
Can be, look, a solar panel, if it's attached on the roof of your main home, it's part of the dwelling. If it's separated on a detached garage, it could be other structure, but knowing that my other structure limits are getting exhausted, I'd argue that the solar panels are integral. It provides electricity for the dwelling, and it's part of the dwelling. So it's a gray area.
So we can push coverage sometimes where it's needed. So if one bucket is overflowing, then we try to push it into the other bucket to expand coverage. So if you have solar panels out in the field, there could be an argument had there.
By the way, it's not landscape, it should be hardscape.
Hardscape.
Landscaping is part of
A.
Yeah.
So extended replacement cost, does it exist with other structures? It can. If you have that endorsement that says in a declared catastrophic area that it kicks all those A, B, C, and D buckets, sure.
And by the way, excuse me for a minute, most policies just say under extended replacement, the dwelling limit. Nationwide and some of the others is, and AAA, by the way, is the dwelling and the other structures. So if the base limit goes up 50%, for the dwelling, the base limit for other structures goes up 50% too. So again, read your policy, read the endorsements.
I want to talk about debris removal and other structures. There's some caveats there. So if you think about your debris field, it's the building, the dwelling, it's your personal property in there, and it's other structures. How many people here have a pool? Wow, it's a lot of people.
It's hot here. Yeah, it's ready.
We're from the Bay Area, sorry. So how many people here want to salvage their pool? Okay. 10 power pole, anybody?
Good.
Right on. Good. So look, yeah, get a 10 power pole put out there, salvage your pool, because if it gets damaged beyond what it is, they can deny it. Your job is to mitigate further losses. It's in the policy, folks. So whatever it takes, make sure that you're communicating and getting that. So if it's $3, $4 grand, $5, $8 grand, whatever it is, to get a 10 power pole to feed the utilities to get that pool going again and salvage it, get it approved and get it done. Get it done, get it approved by the adjuster. So the cost to put in a power pole, what was it, just as an example?
This guy has some questions. Where's Kyle?
The city, to get the permit, I literally walked in, it took 5 minutes.
Great.
They handed it to me the next day, they were there. It has been like that.
Good, that's really good. Responsive is really good.
Responsive, and it also will help save your landscaping if you're.
That's right.
So keeping the landscaping and the pool up,
And that's a good point. And for those
Yeah.
of you that are going to think about selling the property as is, distressed at some point, and you have a pool there, well, the pool can add value to a new family coming in or somebody that wants to buy your property. So salvage that pool, and you got to mitigate damages.
And you are required to do that under the policy.
Yeah, and if you let it go and the landscape go, you can't claim it.
There was a
They'll-
gentleman
they'll-
in red
they'll-
shirt had a question.
Yes.
I want to take the pool out, and can I get that debris removal out of the dwelling policy instead of the other structure damage removal?
Great question, and the answer is they do not deal with pools. So Cal Recycle will not remove your pool. Yep. Has it
Well-
been damaged?
I don't want it after 2 years of not being there.
If it's
If
not damaged,
damaged,
they don't
yeah.
owe for it. It's got, you have to have damage, and then what is the measurement of the damage, and then you get paid. Does that make sense? Yeah, you gotta, so if the pool is damaged and it's gonna cost $15,000 to get it back to pre-loss condition, then that's what they would pay you. But if it's not a total loss, meaning the pool is completely gone, then that's a different story. Then they'll pay for the whole thing, up to the limit of other structures.
If I may. So whatever you decide to do with the money, it's entirely up to you. You may have other structures that are damaged. So it's important, that if you want to, and you're doing it privately, not using Cal Recycle, then you could look at the different other structures, and if you're over your limit, that 5% kicks in, maybe, and they pay you because you're doing it privately. Maybe it's set up in such a way there you just give them a proposal and they agree to pay the 5% versus incurring it. You can tell your demo contractor, hey, just do the pool. Or maybe you shop it and you save some money but pay a little bit more to get the pool removed. So it's up to you how you want to decide to do
Yeah, you
it.
can move your money any which way you want.
Sure.
So I have a question about swimming pools. My swimming pool had the filter and the pumps and everything inside the dwelling.
Ooh.
So can I consider that as a part of Part A?
Yes, I think so. I also think that the carrier could argue that it's used to service the
Other
pool,
structure.
which is a separate structure. No different than my argument on trying to get solar panels or a well that's damaged not to be other structures, but to be part of the dwelling. But I would certainly take that position with them
Definitely.
because it sounds like your other structure limit's going to get exhausted.
Absolutely.
Yeah.
Yeah.
So my second supplemental question is, in going through this so far, my insurance agent has indicated that my decks, which are required to access the building, are a extended portion. It is extended building versus the actual structure, and I'm arguing, saying I can't get into
If the decks are attached to the house, which more times than not they are, they put a ledger at the house, it's definitely building.
Great, thank you.
Hot tubs. Yeah, we got a question here, and then I'll get into hot tubs.
I don't need that, I'm gonna be loud. We've been through the same situation. Our swimming pool is probably 15 to 20 feet from the house, and the deck is definitely attached to the house.
Okay.
We were told that's part of the building extension, not part of the dwelling.
Concrete deck or
Yes, concrete deck.
a redwood deck, you always, it depends. Now, there are some people that put a redwood deck and they don't attach it to the house. That's a separate structure. Concrete's a gray area. Typically, they'll put the concrete, but they don't dow into the foundation. I think you could make an argument that if it's dowed into the existing house foundation, which I had done on one of my decks, I think you could make an argument as part of the building. But you have to look and see, and the concrete should still be there. You may want to, verify that, inspect it. If it's not dowed in and it butts up, that's a gray area.
Okay, but you're kind of a catch-22 situation.
And,
Well-
and you're gonna probably have more coverage there, because
Yeah.
you may exhaust
Yeah.
this B coverage.
I mean, I'm
so you do wanna
suggesting.
push it in there.
I'm sorry, Rita. I'm suggesting that obviously you want to find out where your different buckets are and the costs. If you're thinking that your dwelling coverage is going to get exhausted, then I agree with the carrier. Hey, that concrete deck is part of separate structures. But if you're like everyone else and your separate structures are going to get exhausted, then you'd want to argue it's part of the building. But it technically has to be attached to the building. Now, if you had a deck, a patio deck, and you have an overhang from the roof of your home, like a gazebo style, my opinion, that concrete deck is part of the building, because it's got a roof overhang.
Yeah, so it's never, you gotta push, push coverage where it's.
You understand where I'm going?
I know exactly where you're going.
Okay.
We've gone back and forth with this, and we've had the pool people come out, we considered, pulling it all out. We don't wanna get rid of it, we want, or replace it, but where we are now in terms of expense, we're gonna keep it building, and the extension, because of the cost situation, the demo, and it costs more to pull it out, just, and then
Does.
you gotta put it in.
Right.
Costs the same amount again.
Sure.
So that's kinda,
Yeah.
that's a silly.
And I get it. I have a pool, and I don't use it that much, but for a young family couple, that's a nice thing. So it's all relative.
Okay, now, the other one, I was out of the room, temporary power pole, put the equipment back online, so we can take care of that pool. They're talking, the contractors, the pool guys that built it, we know them well, they're talking about just kind of technically winterize it for a couple of years.
Sure.
And drain it, and do what they need to do, and then kind of reshoot the plaster at the end. And we can take care of it out of the extension part of it. I've already talked about the cost. That's
Okay.
okay.
Yeah.
I've got a little bit left to take care of it.
Yeah.
At the end of the day, you're gonna have a bucket of money, whether it's dwelling or the structure's personal property. I've seen people take some personal property money, 20, 30 grand worth, and just shift it into anywhere. You can do that. So when you look at the different ABC buckets, dwelling, other structures, and personal property, you can do whatever you want, shift the money. It doesn't, just because you got paid in those different buckets, doesn't mean you can't use some of your personal property money to upgrade a house. You can do that.
The inventory and your personal property, how do you include that pool stuff in there now?
We'll talk about it. We're gonna get to that. That's the next slide.
Power pole,
Huh?
and when you set that, and have a pool company come in, and set the pumps,
Right.
and the filters and so forth, what category does that come in?
That's other
Is that
structures.
extension?
Other structures.
Out of structures, out of.
Yeah, unless
Yeah.
you're in this scenario where, we'll be right with you, where you have, it could be argued that it's part of the building. Is it bolted into the dwelling somehow? The utilities. So you've got some negotiations there going
Yeah.
on. Same with you. Question?
Yeah, you mentioned that about putting up a temporary power pole, but would you do that before the debris removal? And how can you do that if you would then be trying to mitigate your loss of the pool, but you put up the equipment right where they're gonna have to scrape the ground? How does that work?
Do you want to talk to that?
They put it at the edge of the property, try to keep it out of the way as much as possible, just 5 feet from the sidewalk. In that, there's an easement on everybody's property, say, 5 feet or 15 feet, for power and stuff like that in the gas lines. So they put it right there on the edge of the property. The permit. The pool equipment is far.
All of our pumps and everything were burned, so we can't put them back, because that's where we're going to be removing.
But your pool's still there, just the equipment burnt down. So if it were me, I would want my pool back up. I would get a hold of the pool company to put in the pool equipment and do a temporary power pole to keep that up and going. Eventually.
How are we going to do that? Because you're gonna have to put the pool equipment where they're going to scrape the property 3 inches into the dirt.
Sounds like you might have to wait. Yeah, you might have to wait, logistically.
Mitigate the damage to the pool.
That's right. So that's your argument.
Well,
Hold on. Make sure that you tell the adjuster this scenario in writing. That way there's no surprises. Because if you're going to put in a claim for the pool because it couldn't mitigate on time, there's a reason.
Well,
and it's justifiable and defendable.
You could get a generator, all right? Could get a generator, get the pool equipment hooked up. You could have a pool company come out, And every couple days, go ahead and clean the pool. That's covered. It's part of other structures, but that's covered. The only other thing I was going to suggest, and again, I don't know enough about it, but if the temporary pole is set up, on a corner of the property, is there a way to get a line without having issues with the demolition to the equipment? That may be another way to do it.
Wouldn't you be able to also, as part of maintenance, be able to get your temporary living, be able to cover that as well for pool maintenance?
No, separate structure.
It's typically separate structures because you're repairing the damage to the pool. Now, I like the thought. I like that. All right, that's a good idea. So what happens if you move into another home, and let me finish, and the home you have, and the pool's damaged? Okay, your pool's damaged, and the home you move into doesn't have a pool. Insurance company could say, you were incurring $50 a month for cleaning your pool. You're not incurring that now. So from this monthly allowance that we're giving you for your house and furniture rental, we're going to deduct out $50 because you're actually saving money. Just be careful with that.
Question.
I'd just like to add that I think, in my opinion, PG&E is completely overwhelmed, and putting in a temporary power pole is going to take probably weeks, if not months.
How fast did you get your pool or your temp pole put up? 2 days. Okay. You guys might want to get her number, talk to her, because she sounds like she's got it dialed in, quite frankly. That's pretty good.
Obviously, you got to put a fence around the pool for safety. So where does that come out?
Other structures. So anything to do with bucket B, anything. If you're touching it, if you're mitigating, anything is going to come out of those funds.
Unless you put a pool around the entire property,
A fence.
meaning as a fence, pardon me. You put a fence around the entire property because you need to protect the other areas, or it's part of the reconstruction because you're going to be rebuilding, then you could get it covered under coverage A.
Hey, Reno or Kenny, would you mind covering the mileage if, let's say, you did have to put a generator on your property and you have to keep going back to the property to maintain the generator?
Yeah, I think, it's an interesting area. I mean, I could see the carrier arguing it's other structures. I like your approach. You could argue it's part of, well, here's the problem. Additional living expenses, we'll get to it, are expenses you incur in order to resume your normal lifestyle. If you're saying to them, I'm using the pool, and you're actually using the pool, even though the site's damaged, then I think you could argue it's part of your additional living expenses. If you're not using the pool, then the carrier could argue, look, we're really not using the pool. This is to protect the pool from being further damaged than its other structures. Does that make sense?
Did you have a question? Was it?
The mileage, by the way, back and forth, if it's to be able to use that pool, even though your house is damaged, then that would be additional living expenses.
Did you have a question, sir?
Yeah, I didn't have, lose my house, but I had damage to the house.
Mm-hmm.
And then I have other structures, which is the pool and all of the pumps and all that.
Mm-hmm.
Well, it all came out in one check.
Okay.
So how do you divide that? I mean,
Well, they should give you a summary of account, and it'll be on the summary. And you want to make clear how they measured the damage, the scope of damage, the unit cost of the damage, and then in that one check, there's a summary. In the summary page, you should get that'll say what each payment was towards. But you don't know if it's right or not. They just sent the check. It's like, is this correct? What,
that's why I'm saying.
Yeah. Yeah, you need. Well, bottom line is you need to be making a claim, because if you were owed $300,000 and they give you $150,000, there's no law that says they have to be right. It's your job to tell them what they owe you.
That's what I was wondering, because am I gonna be able to go back to them now after they had already
Sure. Yes.
checked?
Yes.
And with, like, it's gonna be $10,000 just for the pumps and.
Absolutely. Yes, you can go back.
Wiring and
Right.
new piping and stuff.
You can definitely negotiate. Just because they sent you a check, folks, that's just the beginning. It's called an undisputed amount. It's an advance. Thank you for the advance. We're going to continue to negotiate, and I'll provide you with proof of why it costs more than what you've given me, Mr. Insurance Company. Question.
Are you going to get into this claim, or this list of things that they're paying you for, like the overhead, the contractor's overhead, the taxes and all that stuff, and how they come up with it? Because they sent me something, and it doesn't jive, it doesn't add up, it doesn't, there's no way of understanding what they've sent me.
We're going to send you around a sample of a dwelling claim. So the insurance company came up with
It's a
numbers.
sample dwelling claim.
So take a look at this. This is the language of insurance. This is what a claim should look like. The insurance company gave you a check, but you don't know if it's right, wrong, or indifferent. Who came up with the numbers? What was the methodology used? Was it replacement cost? Was it appraised value? Are they paying for profit and overhead? Are they paying for soft costs, engineering, architect, all those permitting? So when you get the claim, when you get a payment, it should be with a scope and unit cost breakdown. That should look like this thing that we're passing around, this claim. And what it is a document that shows how they came up with it. If you're getting paid the appraised value, the fair market value, then where's the copy of the appraisal? Do you challenge the appraisal? The only time you want to challenge an appraisal if you're going to cash out. If you're not going to rebuild and you're just going to go to SLO or Pismo Beach and live on the beach in a bungalow and you're going to rent, you can do that, but you're going to leave a lot of money on the table. So the appraised value is one method that they're going to pay you on, and you can challenge it if you're going to just cash out. If you're not cashing out and you're going to rebuild or replace, it's really a moot point. Don't spend the energy doing it.
If I may. So there's two claims. One's a custom high-end home, and it's Excel driven because Xactimate, which you're hearing about, which is what State Farm and 98% of the insurance companies use, is a computer-generated program. And it breaks things out line by line. But it's only as good as the person entering. You've heard the saying, garbage in, garbage out. When you have a really super high-end custom home with some very expensive finishes, unless you know how to manipulate Xactimate and address shortfalls in pricing, or address, for example, a tile shower. You put in tile shower and they give you 65 square feet at X amount of dollars, versus a tile shower with 12 or 15 linear feet of feature strip, bullnose tile, in mud, diamond bar strips. It's all about the detail. So when we put together an Xactimate estimate and give it to the insurance company, we're taking into account that you had 3 coats. You had a primer and 2 coats of paint on the woodwork, where insurance companies typically think they can do it in a prime and 1 coat. Can't do that anymore. The drywall that's made is not as good. The paints aren't as good. You have hardwood floors. Was the hardwood floor blind nailed in? Is it random widths? Subfloor. Was the subfloor tongue and groove and screwed in versus nailed in? All those things add up. Architecture and engineering fees. Supervision. Insurance company said, oh, it's part of overhead. No, it's not. It's a separate line item. Daily cleanup. There's line items for that in Xactimate. So you got to make sure that whatever document they're giving you, it reflects what you had. And every home is unique. Your home, and there are some homes here that are built in the 40s and 50s, much more expensive construction, full dimensional framing, lath and plaster if it's back in the 40s. And you want to make sure your estimate reflects exactly what you had.
So definitely take a look at it. We got some questions coming up. So take a look at this this document that they're supposed to provide you with. Here's a payment. Here's how we came up with it, and then that's when you start to negotiate.
Called a statement of loss or summary of loss.
Or the Xactimate estimate, the scope and unit cost of your building. Yes.
So I have a 2-part question. What are you guys' fees? Are you a straight percentage fee, and is that something you can add on to the cost of the insurance? So if you have a total amount that, my claim has, and then you have your fee on top of that, does that get covered in, if it's still below the limits?
Well,
We get paid from dollar one. It's 10 cents on the dollar, 10% typically for a homeowner's claim. And we get paid on the back end. As you get paid, we get paid. For those, yep. It's, yeah, you're hiring a firm to represent you. So our fee on average, because we track the metrics, we're anywhere between 25 to 80, sometimes 200% more than you'll get on your own. Unless, the caveat to that is, unless you're grossly underinsured. If it's a slam dunk and they're paying you all the buckets, you don't need our help. But if there's room to add value, then that's when if it makes sense for us to get involved. It has to make sense to us, and it has to make sense to you. So when we meet with potential clients, and by appointment, we sit down and we look at the overall policy. How does the policy respond? We look at your issues. What's the end goal? What is your goal? Do you want to cash out? Do you want to rebuild? Do you want to replace? And we look at it and kind of come up with a claim management strategy. And if it makes sense, we'll show you where we can add value. We don't just take a claim to take a claim. We're plenty busy. It's a matter of, can we help these people and add value to the process? And we get paid for that on the back end. Does that make sense? That your question?
Yeah, I was just still, does the insurance cover, like if, just say I have $600,000 total, and I have $500,000 in cost. So you're at $50,000 for your fee. So will I be able to get $550,000 from the insurance, or
No,
just $500,000?
no. The insurance policies do not pay for public adjusters' fees. However, I need to ask you, who are you insured with? Is it State Farm?
No.
Okay.
I'm insured with Grange.
Grange, okay. Well, let's give it an example. So State Farm, you get your money. Doesn't matter. You can negotiate after you get paid on what it's really going to cost.
Right.
And by the way, don't hire a contractor and, let him know what your settlement is before he gives you a number, okay? Don't do that.
Yeah.
It's about two paths of travel. The insurance path of travel, collect the maximum dollar that you're owed. The rebuilding path of travel, keep it separate from the insurance.
Yeah, the project and the settlement are different. Because you'll have, the settlement's one track of recovery. Great point.
So
Ken.
because you may, once you settle, you can do whatever you want with it. And you may find out that the contractors get hungrier, or what you thought it was going to cost is going to cost less. Or you're State Farm and you get paid all of it up front, once it's agreed to, and you decide to build something smaller.
Question.
Yeah, could you please talk about the difference between detached and attached fencing and how that might differ?
Good question.
So some policies have a detached, where it's fencing attached to the building. You can sometimes argue it's part of the dwelling. Some policies spell it out. Detached fencing, that's a separate structure. You got a corral. You got a fence around the pool. That's considered detached fencing.
In our particular case, the fence around the pool has attached to the house and attached to the external garage.
I would make the argument that it's part of the building because it's continuous, as long as your policy doesn't spell out that fences are considered separate structures, even if they're attached.
Yeah, there's going to be language in your policy that talks about
And what's normal for State Farm, any idea?
I have the policy. Normally with State Farm, I'm usually getting the fences that are attached to the house as part of the house.
Because that's a bigger bucket, so you want to push that coverage there.
We have another question.
Yes.
Do you have a limit on the amount or like the value of the cases that you take?
I mean, it'd be great if it's a $2 million case, we'll take that. No, we typically, first of all, we're here to help everybody. We'd love to handle everyone's loss, but typically if it's, the loss is below $500,000, it may not make sense for us to be involved.
We'll still be happy to meet and go through the program and help you understand it. So we have a threshold where it makes sense for us to.
By the way, that $500,000, that's
everything.
That's with everything combined, personal property and building. So.
Right. And your pie chart that you had up there earlier, is that in any of your paperwork here?
The pie chart, no.
Okay.
No.
But we can probably give you a copy of it if you'd like. I'm sorry,
Question in
there's
the
a
back?
couple questions back there. Rich, left side.
So if you have, the house actually sat on three lots that had been merged together that can be re-separated. So if you chose to separate and build two separate structures, would they only cover one house, or could you cover two houses?
Was there two houses there?
No.
All right, so are you asking the insurance company to pay for two homes when you lost one? Is that the question?
So basically, I think what she's asking.
I'm a little confused.
So I think basically what she's asking is, say you have a 3,000 square foot home.
Mhm.
You can't build two 1,500 square foot homes.
That's interesting.
I don't know about that. You know, it says rebuild. I think that you measure it based on the 3,000 square feet.
Right, get paid.
You rebuild it. As long as the rebuilding cost for two 1,500 square foot homes is not more than the 3,000, I think you may be able to do that. You know, they could say, well, it's not like kind, but I don't think that matters. You measure what it would cost to put it back the way it was. And then as long as you expend it, because it says, if you read the policy, it's called loss settlement provision. We owe you the smallest of the following: the applicable limit, the cost to repair and replace with like, kind, and quality, which may be over the limit now, or the amount actually and necessarily spent. You spend the money. Now, the only problem with that caveat, I had this happen with an Allstate claim, is was it necessary to build two separate homes at 1,500 square feet? But it doesn't matter. It didn't cost the insurance company any money, and that's what I would argue.
And my next question, and you blipped on it, but and I'm sure you may be coming back to it. I heard you say something about, you know, if you get this money, don't go pay off your mortgage company.
I think you
And
had
what's
mentioned
the pros and cons of that?
All right. Pardon me. So if you got a $200,000 loan and your rebuild costs are $400,000, where are you going to get that money? If you pay, pardon me, if you pay it off, you're not going to have money available. You have to then get a construction loan. It costs more money, or use your personal property. So my recommendation is, until you know what you're going to do, I would not pay the loan off. And by the way, if you pay it off and you decide you want to rebuild somewhere else and you have to get another loan, interest rates are higher than they were 3-4 years ago. So I would wait and figure out what you're going to do. If you're definitely buying a house, yeah, no reason not to pay it off.
Does that make sense?
This might be getting a little ahead of things, but if you're going in to rebuild your existing house, you've already got a lot of money sunk into that house, right, in the water meters installed, that you have your septic tank, in our case, is already in place.
Mm-hmm.
You've already paid school fees. How do those things get factored in or out of the cost of just rebuilding the structure?
He's talking about the municipal utilities?
Yeah. Well, the municipal utilities, if they're not damaged and they're there, it's not part of your claim. When you rebuild, by the way, you shouldn't have to pay school fees because you've already paid them.
And how do you know if they're in or out of that settlement?
Because, well, I mean, you need to understand how that document reads. Obviously, you know, if you are not obligated under the policy to be compensated for school fees if you're just rebuilding your home where it was, or even somewhere else. And if there are school fees, it really shouldn't apply because this is a fire rebuild, and that's what you tell the city or county. And you look at your estimate. Now, if you have to incur for some reason, then obviously it would fall under that code upgrade language. Okay. Yes.
Just real quick, back to the 25% for the extended
Extension?
replacement.
Under farmers
Okay.
policy.
Right, under farmers, I'm being told that if I pay off my mortgage, I don't get the 25% because it's considered relocating, not rebuilding.
What does the policy say?
You can rebuild wherever you want and get that, as long as it's agreed that the 25% would be necessary to rebuild on site. You can get that. I think what they may be saying, maybe they're confused or you're confused, is that you have what's called code upgrade coverage. Now, if you buy somewhere else, you're not going to collect for the code upgrades typically.
One more question, then we're going to move on to personal property.
In regards to coverage B and coverage A, we evacuated a trailer with all of our most precious possessions and whatnot. I had 18 guitars in there and all of our art and stuff in a trailer, and we had a 4-car carport that, you know, I had my tractor in, quad runners and stuff like that. Well, the house didn't burn, but everything else did. Now there's stuff that's out of the house that was lost, like I said.
Personal
valuable
property,
stuff
that's personal property. Oh, watch the mic.
that was taken, like I said, but burned in an outbuilding. How does that?
So the outbuilding burnt, that's other structure. Everything inside, the way to look at that is take your outbuilding and trailer and just dump it out. If whatever fell out was personal property. So you've got a personal property claim and other structure claim. Does that answer your question?
Yeah, it does,
Okay.
because talking to an insurance agent, the allowance for other structures and for motorized vehicles and stuff was all just really low.
Right.
That new John Deere tractor in there.
Was the John Deere tractor to service your land? Then it's part of personal property. Even though it's a motorized, that's the only exclusion. So motorized land vehicles are excluded, like your automobile, things like that. But if you have an ATV or a tractor that services your ranch or your land, it's considered personal property. And it'll say that in your policy. Say as long as it's used to service the land. Yeah,
Yes.
absolutely. Okay. Well, I want to move on, just to be respectful of everybody's time. Moving on to, real quick, the last thing, code upgrades. Sometimes they're available here under B. So if you build a garage or a workshop, it has to be brought up to code just as well as your dwelling. Okay. Coverage C, personal property. This one can take years off your life, folks. Everybody agree with that? Yeah. Oh yeah, absolutely. It's a real thorn in everybody's side. Hot topic. So in this example, we have a $300,000 base limit. There are sub-limits to that, which we'll get to over here. Scheduled items. Scheduled items means I've taken out extra insurance for my fur, for my diamonds, for my coin collection, things like that. Those are your scheduled items. Sub-limits here would be business personal property. How many people here have business personal property, whether the business is ongoing or defunct at this point? How many people have that? Okay. Do you understand what the limitations are? Anybody? There's a limit on the policy. It's typically $1,500.
Every policy is different. Sometimes it's $2,500, sometimes it's $1,500, sometimes it's $5,000. And typically what it is it's for personal property used for business purposes. Now, there may be some people that have a computer and they use it for personal use, and periodically they'll use it for business. I don't think that falls under business personal property. But you have to be cognizant, and you have to also look at the policy. Most policies now, and they used to have language where they would exclude business personal property used at any time. So you could have had a business 10 years ago. Most of that language has been removed. So typically, if you had a business and you liquidated it and you kept a lot of assets and they were in your garage, that's not considered business personal property. But again, you got to look at your policy.
Scheduled items, like we said, jewelries, furs, etc. What does it take to get paid? Look, the insurance companies are smart. They're going to hedge their bets that when you guys make your list, you're probably going to forget 30%, 25% or more. They know this. They've done the math. And they're also going to hedge their bets that you're not going to replace, and it's safe to say, every single item you lost in your home. We store stuff. It's in the garage, under the bed, up in the closet. I got stuff from high school. I'm in my 50s. Don't ask me why I have it. So the bottom line is, I wouldn't replace that, and they know that. So what they do is they heavily depreciate. They take a heavy hand on depreciation, and the insurance company gets to keep that depreciated money. It's called a holdback until you replace the item. An example of that is a couch. You bought a couch for $1,500. They depreciated, just an example, $500 for wear and tear, age, condition, etc. Now you get $1,000. That's your actual cash value. This ACV means actual cash value. Well, how do I get my $1,500? Well, you got to spend it, and when you spend up to $1,500, they'll give you your $500 back. If you don't, they keep it. It's a windfall. So is it safe to say that you're not going to replace everything? Of course it is. They do the math. They know how to do it. So what do? Your goal is to, if this is your, just as an example, if this was your limit on personal property, the goal is, how do you walk away with $300,000? How do you get them on the hook for that? Well, you got to get the claim up and above by doing all the work. The devil's in the details. And for example, let's say you came up with a list and it's $400,000 replacement cost value for everything, and everybody agrees. And they depreciate $50,000. Now you're at $350,000. That $350,000 after depreciation is greater than the limit. They commit, and then you get paid and you walk away. Because if you don't do that and it falls under this, then what happens is you're playing cat and mouse. You have to send in receipts to some cubicle farm employee sitting there scrutinizing every purchase, and man, that'll take years off your life. Never mind making the list. Try dealing with somebody at corporate saying you submit your 3 shirts you bought and they're not the same. Things like that happen. It's really frustrating. So the goal is to walk away.
If I may, we're passing around a personal property sample claim. You can pass it around after you're done. It's pretty comprehensive. When you do your personal property, you want to list everything. And we have some memory guidebooks out there. They're just sample memory guides. But you want to be diligent. And part of it is not just the depreciation. It's getting the appropriate replacement cost. Insurance companies would love you to group things. But there's a big difference between a cocktail coffee book, hardback, versus small little hardbacks or paperbacks. You may have some expensive suits or a dress. You don't want to lump all the dresses. So you want to be specific about the replacement cost measurement. It includes tax. It includes suggested retail, not sale price, because you may not get that item when you replace it on sale. Installation. So you want to taxes, sales tax. So you want to get it up as high as possible. And you want to inventory everything. The wooden hangers, the wooden shoe trees, the original photos that you had, the cost to frame the photos. Anyone go out and frame a print? $200, $250 minimum.
It's expensive.
So it all adds up. And then we're going to give you an example of depreciation. And just the example Reno gave, it's never going to be 10 or 15% depreciation on personal property. Insurance companies depreciate things 30, 40, 50% unless they're given the right information. And depreciation is not based on age and useful life. It used to be in California. It's based on use and condition, and I think the next slide will talk about that.
So this is what it kind of looks like, and when you take a look at this personal property claim that we're passing around, it's very detailed. So I know this is small, but it's going to go like this. So first column would be the quantity of items. This is an example of how you want to list things. Next column is the description. Devil's in the details. The more you hit them with details, the less they can argue. When you leave things vague, they'll be happy to interpret that for you. So description. Next column would be today's replacement cost. What does it cost today, like Ken said, good point, to replace? So first line was it's $100 to replace. This is quantity 1, $100 replacement cost. This is important. Where do you get your cost source from? You need to create a narrative, show a buying pattern. They want to see how you shop. Where do you shop? If you leave it up to them, they could find something locally on directbuy.com from Oklahoma. When you buy locally here, and you got to defend the position. So showing where you shop and your buying pattern is really critical to support the dollars, and the description. Depreciation rate. Every line item, and for those of you that have anywhere between 1,000 to 3,000 square foot home, I would venture to say you probably have 4, 5, 8,000 line items of merchandise in there when you add the tools and everything in the garage and the workshops and everything in your home. I mean, everything has to be accounted for. So every line item gets depreciated differently. Every line, yes.
Things like art and
Art.
classic guitars, things that appreciated value.
So those items are at today's replacement cost. So for instance, if you get on a Reverb or eBay to buy your gear, your guitar, if you paid in the 70s, because I collect guitars, I feel your pain. For instance, you paid $1,200 back in the 70s, but today it's $6,000 for a Travis Bean or something like that, then it's $6,000. So this is what it costs today to replace, period. Plus tax, plus delivery, plus setup.
Installation,
And
if it's an
installation.
appliance.
Question, yes, sir.
By the way, I'll add something else. Warranties. Let's assume the sofa you had, you purchased a warranty with it. Interesting question. If it's a protective warranty, it protects the sofa, and that's what you had before, you can collect for that.
That's a good point. And that, you know how you pay for the extended, everybody's over at the registers always asking you, we want to extend the warranty. So if you had that, then sometimes it's 50, 60, 80, $200.
Yeah.
Yes, sir.
A couple of things. In our policy, it says specifically that historical items, antiques, artwork, things of an unusual nature that have a very special price on them, like first edition books and so forth,
Sure.
are not depreciated, period.
That's correct.
That's correct.
Yeah,
That's
we
the
mentioned that.
percentages.
Any collectibles, antiquities, fine china.
Right.
Now, here's an interesting question. Tools. You have Snap-on tools.
Yeah, there's a difference between that and Craftsman. I
That's
understand
right.
that.
That's right.
And
We know.
lifetime warranty.
Right.
So do they depreciate? And by the way, Craftsman, I think, gives a warranty, lifetime warranty too.
There are warranties on
Yeah.
Craftsman tools
Yeah.
also.
So, I've argued that before. I mean, do they depreciate? Probably, but not necessarily if it's a lifetime warranty. So those are the things that you want to address. And we're going to talk about depreciation, and I guess
So every line item, if you can imagine, you do your inventory and it's 5,000 line items, then you have to go in and each one has to be depreciated because it's not just the age of the item that's accounted for when they come up with this depreciation, it's the condition. So I collect old tube gear. I love the sound of analog tube gear, preamps and amplifiers from the 60s and 70s. And these things are 40 years old, but they're in mint condition because I collect and I use them. So if I was to lose that item, the adjuster would say, this thing, I'm going to depreciate the hell out of it. I got 80% depreciation. I'm going to argue, no, but it's in mint condition. So the useful life, is fine, but the condition of it is in excellent condition. So maybe you can take 10% depreciation.
Okay, now on a library, and this is a tough one. We've got some very specific things that have very specific volumes that we've had for a long time, and we've done some research, and we're very confident that those are pretty solid in terms of depreciation. Now we have a large library with a variety of different books in there, biographies, novels, historical reference books. We taught school for a lot of years, so we have that stuff. And we were told, or it was suggested, that we lump these things into groups in terms of categories, because there's so many things. There's no way we're going to remember every title, author, and exactly when we bid and when the publishing date was. It's not going to happen.
Right.
So how do you deal with that? Are we on the right track, or are we?
You talk about
also going in the wrong
categorizing
direction?
hardbacks from softbacks
Oh,
from
yeah.
education.
I think you can do that as long as you make sure you separate out the categories according to the cost. Like coffee table books, it can be $50, $75.
Right.
Hardback books, $40. Research books,
Yeah,
educational books.
That's
Yeah,
Does
that's
that
it's
answer your question?
Yeah,
Okay.
and first edition, that's a little different. You should try to. Yeah, good.
We have a team of people, when we're handling a case, just to give you an idea of how exhaustive it is, we have one person sitting down to recreate every single item, and we have a patented memory jogging system because we've been involved in so many firestorms, to recreate room by room, item for item, what was in your house. That's capturing the stuff. Then we have a research team that goes out and finds out how much does it cost today to replace that same item, something similar, whether it's an antique or not. And then once we capture that cost, then we have to figure out what is the condition of it. And that's where you would come in and say it's in either fair, excellent condition, good condition, and that's where the depreciation starts coming into play. This number is very subjective. The insurance companies like to depreciate as much as they can. Remember, knowing that if you don't replace it all, they get to keep that money. So every line item has to be looked at separately, negotiated separately, and this is critical because it's very negotiable. Very
An
negotiable.
example, you know, you may have, like my wife, she's got dresses and a lot of blouses. It drives me crazy because the name tags, the price tags are still on it. And it's 5 years old. Do I say 5 years? No, it's never been worn.
Right.
So that's use and condition. So when you put this inventory together, you want to make sure that they're aware. You know, I have a lot of Allen Edmonds shoes. They're nice shoes, and I wear them a lot. I alternate. I have 12 pairs of shoes. You know, shoes normally last 3 years if it's just one pair of shoes. But these are going to last longer. So it's all in the detail and the use and condition. You know, the describing a desk versus a desk with scrolled legs, solid wood, dovetail drawers. You know, they don't even make them like that anymore.
It takes hundreds and hundreds and hundreds of hours to do it properly, folks, and you got to do it right. They know they can wear you down. They've got all the patience in the world because they may have given you a small advance against it, or even 50% against your contents, but they know you're going to throw your hands up in the air at some point. And by the way, you don't have to use, we'll be right there, you don't have to use their program online. That you can do it on a napkin if you need to. So just be aware that you don't have to use their system. Question back there and here. Question back there and here.
Back there, Rich. Back there.
We've been told in Santa Rosa that for some reason some of the insurance companies waived this requirement that people could write hardship letters for whatever reason, and some insurance companies just gave them the full 100% based on that. Is that really rare?
Yeah, it was very rare, and it happened 4 or 5 months later with a lot of political pressure. And we told our clients, you know, because it was so laborious, you know, and there were some congressmen that got involved. There was only 1 or 2 companies that I know of that did that. And because there was a lot of political exposure. I don't know that or think they're going to do it here.
Yeah, you know, one thing I can say that when we go from firestorm to firestorm, nothing's ever the same. What they did in Santa Rosa doesn't necessarily mean they have to do it here. There's no protocol like that. They'll just, different adjusters coming in and out. The company has no one standard for every firestorm. Depends on the size of the firestorm, the political pressure, the pressure from us as public adjusters, et cetera. You had a question, real quick?
2 questions. One is there a time limit on when you can negotiate a claim with the insurance company? And number 2 is, I forgot it. No,
It's okay. We'll get back.
When it's a declared catastrophe, normally there's a time limit to replace your personal property in your building within 1 year, but you can always ask for extensions. When it's a declared catastrophe, you have 2 years, but then you can also ask for extensions. There is language in a lot of the code upgrade policies, you know, or part of the policy, where it says you must replace your code upgrades or incur them within 2 years. That may not happen. I mean, I've got a client in Santa Rosa, they can't even start to rebuild yet because there's benzene in the water supply. You may have heard about that.
We have a question here. We want to move as fast as we can because I'm trying to stay on track. I respect your time.
Well, it's really, I mean, I know every insurance is different, but I already have a friend who's already settled for 100% of personal property because they sent someone out to interview them, and in 3 hours it was a done deal, where I just have a spreadsheet. It's not even a program, and it doesn't ask me where I shop. I mean, it's literally just like 3 columns that I'm filling out, and that's it.
Did they give that to you?
Yes.
Yeah, so they're keeping it vague so that they can control it. And to comment on the first part of that, they were probably grossly underinsured. We've met people with 4,000 or 5,000 square foot homes that have been there 20 years, and they were grossly underinsured, they just cut them a check. So does that make sense? That's probably why.
And by the way, there's a few companies that do step up and try to do the right thing.
Right. Yep. Oh, we're going to get to that question. So after depreciation, you're at what's called the actual cash value total. Okay. Again, replacement cost less depreciation equals actual cash value, and that's the money you get. And then you've got this column, which would be the withheld depreciation. And this can add up, folks. This is what they're holding back until you replace it. Okay, that's how that works. Question? Or no, you're dealing with Richard? Okay. Inventory tips and tools. Keep a pad and pen with you at all times. You could be driving and think about, oh my goodness, I forgot this or that. Draw out each room one by one. Kind of lay it out, get an overview of the house. Visualize drawers, bureaus, closets, etc., including shelves and drawers. Look, don't forget the stuff that's in the attic, under the beds. If you have a modest-sized house, you're scrambling sometimes for space. I do. Use family and friends. Let them help you research and price items. A lot of times after these firestorms, we see family and friends, could be across the country. They call and say, oh my God, we heard about this. You've been affected. How can we help? Put them to work. Take the mental load off of you. Give them a couple of pages of your inventory and say, research the pricing on this. Then get online. They can help you in that respect, so use them. Yes?
I found going through the debris,
Mhm.
even though I didn't find a lot to keep.
Sifting?
I took pictures of it, and it helps for.
Yes, whatever it takes. Another thing is photos. If you had a party or some kind of family gathering with friends and they took a picture, ask them for all the photos, because in the background you can see a lot of stuff. You can see the finished work.
Speaking of photos, people don't think about this, but like me, I've got photos when I took a 35 millimeter camera, and I've got all these photo albums. It's the cost of the film, the cost to develop the film, and then it's the photo album, and it adds up.
Yeah, they really add up. Once you start getting into the details, that's when you start seeing it. And it doesn't matter if it's a toothbrush, toothpicks, man, by the end of it, you want to get that claim up above, way up above your limit, because after depreciation, you want it above the limit so they'll commit to paying the whole thing. Okay, so next category, loss of use. This deals with your temporary housing. ALE means additional living expense versus fair rental value. There's a difference. There are policies that pay this, policies that have that. Do you want?
Yeah, I'll talk about it.
So
let's talk about additional living expenses. It's pretty simple. It's the additional expenses you incur to maintain your normal standard of living. It's the cost to rent a house. It's the cost to rent furnishings. It's the increased mileage if you're further from work, or you're having to go back to the site to deal with maintaining the property. And by the way, mileage adds up. If you're out of your house for almost 2 years and you're incurring an extra 50 miles per week, that's 2,500 miles at 54 cents per mile. That's $1,300 just in 1 year.
So I just want to jump in. There's an app out there, and I've been mentioning it. It's called Mile IQ. Is that what it is, Richard? Mile IQ? Mile IQ. It's $4.99, $4.99. And it tracks everything, everywhere you go. Eye in the sky. But what it does is, at the end of the day, or week, or at the end of the month, you swipe right for business, meaning it's because of the file. Swipe left if it's personal. And at the end, it'll spit out a dollar amount, and it's great. The IRS loves it. The insurance companies certainly would use it. It replaces the old pad and pen on the dash, because that's, looking at the odometer. Who wants to deal with that? This thing's great. It works quite well. For $4.99, it's a huge burden off your back.
RV boat storage, animal boarding, you can't, you've got a property or you're in a hotel and they won't accept animals. Now here's what's interesting. You had a fenced-in property before for your animals. You're renting a house. There's no fence. Do they owe for it? I think they owe for a temporary fence to be put up, meaning you can rent fences. That's part of your additional living expenses. Otherwise, they're going to be paying a lot more money to board your dog every day. And you know what? You don't want to have your dog boarded. You want your dog with you. So if you're in a situation where you have a property, but there's no way to enclose it, and you're entitled to get it enclosed.
Okay.
RV boat storage, just real quick story. We met an Allstate insured, and their RV boat was not damaged, and they don't have a garage, shed to cover it now. It was destroyed on the property they bought. They're having to store the boat at a place, and Allstate's saying, we don't owe for it. It's part of the RV boat policy. Well, there's no damage to the boat. They do owe for it. It's part of maintaining your normal standard of living.
Right. Some people have a dollar limit or a time limit on their policies. Because it's a declared catastrophe, if you had a 12-month policy on your temporary housing bucket, then it gets kicked up to 24 months. However, this is critical, just because you have 24 months doesn't mean that they'll pay you for 24 months. You have to move, once the insurance company pays you some money towards your dwelling, right? It doesn't have to be right. Just they give you an advance or some money towards it. The question I would have to the adjuster is, does the clock start ticking? And what that does is the money for the dwelling that they gave you now starts a clock ticking that limits how much money they're going to pay for the loss of use. For example, they could say, look, we paid you 2 weeks ago. We're going to throw a dart, and within 6 to 8 months, you should either have a new house or rebuild the house, and then we're going to shut off your loss of use money, the temporary rent money. That's problematic. So you need to move with diligence and dispatch. I would have a paper trail, electronic paper trail of what you're doing. If you're talking to an architect, if you're talking to a builder, if you're talking to a realtor, memorialize all that, because if they come back to you and say, hey, look, we're going to give you 2 more months of temporary money here for your temporary living, you need something to come back at. Remember, you have 2 years, but it doesn't mean that if you're just sitting around and thinking that you're going to ride that 2 years out, they can shut it off. Okay, yes?
Does the clock actually start ticking?
Well, you got to ask your adjuster, is it from the point where they gave you that a non-disputed amount towards the dwelling replacement? Or does it start from the date that you got final settlement to
It's
replace?
typically, it starts, okay, so,
Yeah, when right, exactly. Right.
all right, so let's talk about it. You have up to 24 months with State Farm. But if they settle your claim and you're in agreement, and they settle it in 3 months or 2 months from now, okay? You now have the money to rebuild. So now it's a matter of what did they figure in their estimate for the time frame to reconstruct? Are they saying 6 months? Not going to be done in 6 months. Is it 9 months? Maybe more realistic. What about plans and engineering? It could be 9 months to rebuild your home, but you got plans to get drawn up. You got to get them approved. So you want to factor all that in, and you may have time finding a contractor too.
Right.
So that's all part of the agreed upon time frame to complete the building. And you should have discussions with the insurance
It's called the
carrier.
period of restoration. That's the formal wording in your policy. They owe you for the shortest amount of time that it takes to restore or replace your property.
Okay, so they're paying your rent per month,
Yep,
4,000, 5,000.
whatever.
Whatever it is. My question is, when does it start ticking on how long you're going to be able to stay in that living situation? I know you're talking about.
Negotiate.
architecture fees.
Right.
That all's coming out of dwelling expense.
Yeah, but it's we're
No,
talking about
no.
period of restoration.
I'm talking about what's called the period of restoration. What's the agreed time frame to get plans drawn up, get it approved, and get the reconstruction going?
It'll take 2 years in our situation. I know that I've done this.
With due
Okay.
cause, yeah, you got,
So-
as long as you
so-
can prove it.
Yeah,
then
but
they'll pay.
some people may only take a year, but they don't go ahead. They don't use due diligence. They sit around and wait 6 months before they decide to start construction. You know, the carrier could come back and say, look, we don't owe you for that additional 6 months. You do need to use due diligence and dispatch. So like what Reno said before, you document everything.
Yeah, you need to show due diligence that you're doing something towards either replacing or rebuilding your property.
You're in process of replacing,
Yeah, and you have some kind of track record to show them.
and you have a record to show it.
They should be able to extend it. That's correct.
That while that you stand in temporary.
That's correct. Fair rental value is another part of this. Fair rental value is what your home would have rented for prior to the fire. Some carriers will include furniture, some don't. Typically, they don't. So they would do comps on it, and what would your home have rented for with its amenities? If you have a pool, an acre of land on a cul-de-sac, that's a number. And that number is part of what they call the fair rental value, and you get paid that. I've got clients here that want to buy an RV and live in an RV. Some are already doing that, so the insurance company will purchase an RV, because at the end of it, it's cheaper for the insurance company than if they were to stay in either a hotel for the period of restoration or rent a house fully furnished. So any questions on fair rental value, how that works? It's not in, the only companies that we know that have it right now is AAA. Ken, is that correct?
Yeah, AAA and I think CIG Insurance may have that option.
That option, yeah. So for those that have it, you can exercise that, and it's basically a cash out. They're going to give you cash for what your house would have rented for. Does that make sense? Question?
Yeah, okay, my policy, they offered me, because the housing was so limited, is so
Right.
limited.
Yep.
They said that if I couldn't find a rental, that they would allow me to buy a fifth wheel or
Sure.
a trailer to live in,
Yep,
okay?
yep.
But they also, there was a caveat to that, and I don't know if that's in my policy or not, but apparently you have to go one way or the other. You
Right.
can only either buy a fifth wheel to live in, so you have a place to live as long as it takes you to build your house,
Period of restoration.
or you get a rental and you only have the 24 months.
Correct.
That's
They're
correct.
right.
And you can't backpedal. Like,
That's correct.
if you're
That's
not done building in 2 years, they don't have to give you any more time, they're done.
Right, if they bought you an RV and that's it, that's your decision you made, that's it. You know, you can't keep going back to the well,
Right.
basically. But if they're buying it and it's 30, 40,000, they bought it for you, you're living there. You know, you got to ask yourself, is the standard of your standard of living been compromised? Because that's what it says in the policy, that your standard of living is to remain the same. Okay, so
But if you go the opposite route and you get a rental
Mhm.
and you're in there for 2 years, you haven't spent the amount of limit, the
Right.
dollar amount,
Right.
but you've hit your time limit.
they're done.
And they're done. So they don't have to give you the rest of the dollar limit.
That's correct.
So that you can go buy something to live in until your house is done.
That's correct. Yeah, there's a shut-off, that 24 months, if the budget's there, okay? Also, the carrier owes you for the increase due to the shortage of housing. Santa Rosa was tremendous. 7,000 plus homes disappeared. You can imagine the scramble for housing. So there's going to be an increase in a demand surge in your, and not only in your construction, but also in your housing, your temporary housing. Any questions on loss of use? Yes.
With my loss of use, it was only during the evacuation period. And so I went to a vacant home and stayed. So the insurance company is saying that they don't have to pay for my time out of the home?
Okay, that's called civil authority. And there's a paragraph in your loss of use section when you get the certified copy. It'll talk about either a deductible period like 72 hours or a week. If it's civil authority, meaning there's an evacuation order, that's civil authority. And then there's a time limit in there. Some are 24 hours. They'll start paying if you're out within 20, after 24 hours. Some say a week. Some say 48 hours. They're all different. So look at that part of your policy. Okay. Who can represent you? This is the last slide, guys. Attorneys. Yes, they can represent you, but you don't have a legal issue. You have a valuation issue. That's where we come in. I've represented many attorneys. An attorney can represent you if you have a coverage issue or a legal issue of some kind. Sure. But does the attorney sit down with you and recreate all your inventory with you? No. Do they manage the process? They can. But how do you, when the number comes in to your attorney, how's he going to say, hey, this is wrong and this is really what it cost? Again, you have to prepare a claim and present it. But they can legally represent you. Public adjusters, of course, we're licensed, bonded in every state by the Department of Insurance. Of course we can represent you. Contractors, no, they cannot represent you. They can give you a bid. You can get a bid for yourself, but you can't use it to negotiate. They're not allowed to negotiate. You need a license to do that. A lot of people think, oh, my contractor will deal with them. That's against the law. In I think it was Paradise a few years ago. There was a firestorm, Chico Paradise area, and they did a sting operation in the Department of Insurance because there were these contractors that swooped in using predatory practices on people, saying, you don't need those guys. We'll do it all. We'll negotiate. We'll come up with a bid. We'll fight for you. And they got caught and went to jail. And we helped the Department of Insurance set up the sting operation because it's illegal. They shouldn't do it. They can't do it. Okay, very important. Insurance agents or brokers, they used to be able to kind of speak up for you, but Senate Bill 488 passed in January of 2017, which no longer allows an insurance agent or broker to represent your interests. They can sell you the policy, but they're an extension of the insurance company. They're under contract to protect their liability. So they can't negotiate on your behalf. They can try to explain the policy, but they can't negotiate. Okay? Any questions on this? Okay. I want to thank everybody for being here tonight and allowing us to share the information with you. We're going to be hanging around. If you got specific questions, come on up. If you feel like you want to dial in something a little more detailed, we can make appointments. There's no cost. There's no obligation to hire us. We are meeting with families day in, day out. We've got a team up here, boots on the ground. We'll be here for months. So I would, if you think an appointment makes sense to you guys, sooner than later, because every day that goes by, the insurance company is doing something. They're doing something, and you don't know what that you don't know what that is. And once those numbers start hitting the table, and it starts getting approved by the corporate, the guys in the glass office, the women in the glass office, it becomes a reactive scenario for you guys. You're trying to prove them wrong when these are the numbers, man. You know, show us where we're wrong. So if you want to shift that burden of proof, where you prepare a claim, you put it in their hands, say, this is what you owe me, here's why, here's the proof, pay me. And then there'll be a negotiation. So again, no cost, no obligation to talk to us. We'll be here tonight and for the next few months. So again, thank you so much. Thank you, guys. Thank you.